everybody. Welcome to Market Mavericks. It's that special time every Thursday, well, almost every Thursday, and we are back here to discuss the markets and the technicals and the charts and what the heck is going on in the world. So let's recap this, guys, and we'll get right into it. So last week we were on, there was mayhem in the markets. Yields were kind of going nuts recently. We've heard, left and right, there are negotiations with China. Oh, wait, China says they're not even talking to us. So I guess the question is, we have a market that is actually rallying pretty nicely. And really the last few days, it's been up like 1% to 2% every day. Is this clear sailing? Is this kind of a fake out? Is it luring the bulls back in? I mean, what do you guys think?
Go ahead, Mike.
Oh, okay. I was going to let you go first, but
I think go. I think it's
you go.
I think it's hard to draw any conclusions yet, right? I would just say that if you're taking a look even at the charts, like you can pull up mine, but the QQQ here, if you look peak to trough, this bounce, that 12% day, and even where we are right now is still just 50%. And right, you almost always, but always get basically a 50% sort of bounce or reaction off any major dump. And you also usually get a 50% dump after any major move up, which I think, we can talk about for a Bitcoin or anything that's kind of had a big move up. Maybe you get some retracement back to a support or something, but more has to happen to convince me. I think the problem is we're just so headline driven. And I just know that any tweet can send this in either direction and retrace an entire move with the next tweet. So it's just hard to really have much confidence.
And Mike, before you jump in there, I just want to mention something and I see your reaction. So for the longest time, when the markets were at all-time highs and we were, basically 10% off the all-time highs, it didn't seem like Trump cared about the markets. Correct me if I'm wrong, but it now seems like if the S&P drops 3% or so in a day, the next day there's a tweet or a Truth Social post that kind of says, oh, but we're talking to these guys. So it does seem like he does care at this point, right?
So I'm glad you brought that out. I think this is definitely what's happening is Trump pivoted on the tariffs, adding 90 days after the market had swooned and the VIX reached 60. Okay, we got that. He pivoted on Powell after, I'm sure Besson said, hey, Don, by the way, this kind of thing with Powell, just imagine if you fire him, you put someone in there, no one's going to, if he cuts rates, it's just the worst thing you could do. It's a lose-lose. So I think what's happening is the market is doing what Ben Bernanke wrote about a lot in his book, The Courage to Act, and that is sometimes markets will really drive everything. And that's, I think, the situation where we are right now is I don't think the Fed eases until the market makes them. It's doing that already, but slowing up a little bit. I think if it collapses again, or I think when, it's going to be more of an when. To me, this is a bear market, that'll make Trump pull back a little bit, but it's all that space right now. We are in a situation where we're taking the most expensive U.S. stock market versus GDP and versus the rest of the world, and we're reverting it for good reason. What stops that? And to me, this is part of the process. It's a bear market. And I think I can show a screen a little bit, and Bitcoin's been awesome for that. So we all agreed when VIX hit 60, you got to buy a risk asset. Bitcoin's the best one to buy. Some people did. I know Scott, you were over it. Gareth, you were over it. And you probably, the average price that day at closing was around 77. But as of yesterday, went up on the day. So what I want to just show you is what's happened. The VIX hit 60 and everything's bottom. Here we had Bitcoin, S&P 500, and 10-year note yields at about 4%. Everything has bounced. Now we're at the key thing. That's why I look at Bitcoin as just a tremendous trading year. It reminds me a lot about 2008, which was one of my best trading years ever. I just held core shorts and added and took out when couldn't trade Bitcoin then. Now I don't trade, I just look at it. So here's my key takeaways. That bounce from Bitcoin from 77 back to 94, it's around 92 now, is an opportunity for a great trade. And now I think some of the prudent, rational, maybe bots are saying, all right, I'll sell now, test some shorts, make it prove strength. Because if Bitcoin stays above and up on the year, it drags everything with it. We can't underestimate how much they're all correlated, particularly when markets go down. So to me, this is a situation right now. It's a great trading environment, but bottom line is, I think I'll end with this. Our Bloomberg economics and intelligence team are expecting a 1/3 drawdown in the S&P 500 for a recession. It's very rare to hear things like that from my colleague Gina Martin Adams. So I'm going with that. I'm expecting a 50% drawdown in the S&P 500. Just a matter of time. It's way overdue. Get it back to 4,000 is where they're looking, but treat it as a trade, make it prove you wrong. And it's a question of how it plays out. Now, if we end this year, it's early on. I mean, we're heading towards the busy season, then we get to summer, it's dead. But to me, the next few trades are Bitcoin's a great leading indicator. The problem is it's very highly correlated. And I want to just show you this chart here is it's the same asset. It's the same chart syndrome. If you take at Bitcoin, the NASDAQ, and the market vector digital assets 100 index, the correlation of Bitcoin to the NASDAQ on 100 days is 0.52. To put that in context, in 2019, it was negative. So they're all correlated. And the correlation of Bitcoin to its own crypto index is 0.6. It's about the same. So treat it as a trader. And this levels right here, I think our levels where prudent traders are saying, okay, risk assets, let's start selling.
Does the crypto index include Bitcoin, by the way?
Yeah. It's 100. It's the top 100 cryptos. They might market cap weight it, which is kind of a typical way to do it. But yeah, it includes Bitcoin.
Yeah, but I was gonna say the market cap of Bitcoin is what, 80% of that, 75% of that.
So they probably have a limit. Typically, they have a limit of 30%. Now I stopped using the Bloomberg Galaxy Crypto Index a little bit because it's only 12. This is 100, and I think we need the broader market in there. And that's my key theme as I look at things like Ethereum. Let's point out a fact about Ethereum. What makes that market go up versus normal mean reversion? To me, it's a classic commodity. Commodities always go back to an enduring price. The enduring price for Ethereum was below $200 before 2020. In 2019, the price is 200. It can easily get there, partly because remember, look at the difference. It's not digital gold, and it's stuck in the middle of those 14 million other cryptocurrencies. If we get the normal wipeout in wealth, which I think we're finally getting, just take it out of the stock market and everything goes down, then those are the things you hit. Anything that has a lot of wealth in it. And gold's the main survivor. We can talk about gold later, but to me, that's where we're heading. And the key proof that will be wrong is if Ethereum can stay above 2,000, Bitcoins can stay up in the air.
Interesting. Gareth, can you bring up my chart really quick before you ask another question?
Absolutely.
It's interesting. Absolutely. Just two sides of the same coin, Mike.
Yeah.
I would say for Ethereum, you're looking at a longer term and saying, normal mean reversion back down to 1,000, whatever. I would say right now, normal mean reversion for Ethereum is that it's way oversold, actually the most oversold it's ever been on the weekly, and should at least come up and test the 200 or 50 MA at like 2,400. So to me, mean reversion for Ethereum versus everything else is to bounce because it's wildly oversold, shows bullish divergence, and it's, sentiment is in the dumps. Maybe that goes to 2,200 and then goes down to 1,000.
Well, exactly. It's traded. Oh, what a great trading environment. Bear markets are famous for that. I remember trading all these stocks in 2000, 1999, 2007, 2008. It's a great trade environment. But I don't disagree with that, Scott. But first, we all know what happens with cryptos if the stock market goes down, particularly the correlations pick up. And to me, that's the bottom line is I think we've entered that stage where most traders who've been trading for the last 15 years have never seen before, where you go down and stay down and you really wipe out wealth. The problem is we have the most wealth to wipe out in a century in this country. And when it becomes prudent to sell U.S. assets, which it has because they're so expensive, for any risk manager on the planet who owns U.S. risk assets, they're selling rallies partly because it's prudent because they're so expensive. They just got to get back to par with the ratings. And this is a key thing I like to point out is you take that S&P 500 divided by the rest of the world. I'm using MSCI ex-US index. It was 1-to-1 from 1968 to 2013. Then it jumped up to 2.2. Now we're just heading back to 1-by-1, 1-to-1. I think that's where we are. Early days, but don't underestimate. Great trading environment, but we're way overdue to just knock off some wealth of the U.S. stock market.
Interesting. So I was going to ask about interest rates, and I want to do that in just a second. But you guys brought up Ethereum, and I did want to just point out that. And I not to toot my own horn here, but last week when we were doing our Market Mavericks, I said, guys, altcoins are going to bust out. I think I said 20 to 30% upside we should be seeing. And that was purely on the charts. And I just want to show you guys like SUI. Look at that move.
Yeah, I'm literally at the SUI chart in front of me because, man, is that pretty.
Yeah, and like XLM was one I actually highlighted. I showed this chart last week because I love these wedge patterns, man. When you break out of these wedge patterns, these long-term downtrends, I mean, that's just a thing of beauty. So again, it just shows you that risk is now back on the table. Altcoins, honestly, were just so bashed. I mean, they were just absolutely crushed. Ethereum still kind of like, honestly, I mean, that's bounced, but
still looks shitty compared to everything else.
Still compared to these other ones, I mean, and again, I actually have a position in Ethereum right now. I'm still thinking it could go a little bit higher, but it does just bring up like, how many other coins like Solana are eating Ethereum's lunch. And Scott, you'd know that better than me. Like, is Ethereum still the queen. I mean, Bitcoin's the king, but obviously that's market cap it is. But is it slowly rotating away from that?
I think it's been slowly rotating away, but it only slowly rotates away until it doesn't, right? And it's not like this wouldn't be the first time that we saw something that was beaten down and had poor sentiment to absolutely fly. So nothing would surprise me with Ethereum. But at this point, Mike, I think I would be equally expectant of 1,000 as I would with 3,000, right? So or 2,500 or something. So it could really go either way, and I've been generally bullish. So I'm pretty muted on it. I own a lot though.
Nice. So let me. You mentioned. Go ahead, Garrett.
No. I was going to change it to interest rates. So if you have something on this.
Yeah, let me show you a chart on that. The macro big picture for interest rates is so much. Here's a chart of what I just highlighted here. That's the 200-day moving average of the U.S. 10-year note yield. It's uncanny how it looks almost exactly like it did in 2007. I mean, again, this was one of my key signals back then. At the same time, when volatility was bottoming from at the back, this is 200-day moving average from the lowest levels. Same thing, crocodile jaws. 10-year note yields just starting to roll over, and we all know McGlone's been way wrong in this one early. I was way wrong and early on crude oil and a lot of other things for a while. It's starting to roll over at the same time the VIX is going up. But what I want to highlight about this is a gold divided by S&P 500 ratio. Gold is still my main asset I think is going to go up this year, but one thing like a bull market got way too expensive at 3,500 an ounce, and if you just take the gold divided by the S&P 500, it bumped up to resistance that's held for 10 years. 2014 on the way down was the last time it closed above that. I fully expect to back up from that, but I fully say in the big picture, if you look at a bottoming VIX from a 6-year low, peaking 10-year note yield from a 20-year high almost, it's about time at some point it pumps up and gets back to 1. I think it starts to do. And this year, in the meantime, you have a good trading environment. But to me, this is the key thing. Look at interest rates. It's just a matter of time that we follow the rest of the world. By the way, right now, the 10-year note yield at 4.31, I think is going to where it is in China at 166, just like they did with JGBs 30 years ago. I was trading them then, and that's just what happened.
I think gold looks topped. I mean, at least temporarily. Yeah, it really does. From a chart perspective, yeah, you never know. It could be a steady bid from China or something. But, man, you don't often see overbought conditions, bearish divergence. That's a slightly higher low. But this candle, man, like that was a blow off top. You know what I mean? There was volume. It pumped up, closed lower, and then you get confirmation the day after. I mean, I know charts don't tell you everything, but if you follow charts, you expect that gold's going to go down for a bit, at least consolidate. Maybe back to 3,000, something like that.
I want to reiterate that. I want to show you guys some other cool stuff on the chart that I came across. Take a look at this. So there's two parallels, and I'm a big fan. Parallels, for some reason, price stays within that range and likes to tap the high end and the low end. And this one, this is gold, right? So the high from 2020, which was just after the COVID panic when it surged up, right? That high and the lows right through here make a perfect parallel where we just tagged it here. And then look at the bigger parallel. In fact, I'm going to get rid of the smaller one. This one goes back to the bull market high of 2011. And look at how it matches perfectly the parallel with the lows. What did we just hit right there where it pierced? This should see rejection. I think we're actually coming back to 3,000 an ounce. I think that makes sense to retest that big even number. Then I would probably buy it again. But I mean, you're dead on. I think this topped. And like you were mentioning, Scott, this is a classic topping tail in technical analysis, which is a reversal signal in the chart. So, yeah, I agree with you. I think, in fact, I was short up here. I got out right in this. Didn't quite get the lows, but close. I'm looking to re-enter. And again, I'm a short-term trader, needless to say. So I'm just looking for quick moves. But if we just get up to about 3,400 again or 3,390, I'll be putting a short on again for that move down at least to about 3,150 to 3,000.
So let me give you a hypothetical on that one. I really appreciate that because gold's been a great bull market. Those who've been overweight gold, which I've been pointing for too long, have been able to sit back this year and just kind of enjoy it and not get hammered. I want to show a share screen on that in the macro. This is one thing I published last week, and just this week. When on Tuesday, gold was up 31% on the year. That's of the top 10 years, the last 100 years, that was number 7. Number 6 was 1934. That was a year after FDR took us off the gold standard or devalued the currency. Number 8 was 2007, right before the financial crisis. What's unique about this is deflation. We've never had this in 100 years where gold is going up and S&P 500, both crude oil going down. That's my point in the macro big picture. We are entering a century event here, and I've been talking about it for too long. I admit it. Where we had the biggest money pump in history, pumped in everything up everything, particularly cryptos, and now it's reverting for good reason. It's a great it's a great environment to trade. So here's a hypothetical for you. If the stock market keeps going down, which I think it will, I think it'll be led by Bitcoin and cryptocurrencies, which we all know when beta goes down, everything goes to one. All correlations go to one. What's left on the whole global space for something that's relatively cheap? And this is what I show right here. And that the one thing is, the last thing left is McGlone's call. But finally, the U.S. Treasury bonds, I think, could drop 200 basis points. If I'm right that S&P 500 just drops 20% in the year, which is 2018, it was 18%. Normal, maybe 30%. Then you get that 200 basis point rally in yields dropping. To me, that's the next big trades, because gold's overbought. Cryptos will be tilting lower. Things like a lot of the bogus coins will go to zero. I mean, that's usually what happens. And the next thing is treasuries. So
are you not worried about instability in the U.S. keeping foreign buyers away from U.S. Treasuries and that keeping rates up, or like do you think that these trade deals will be worked out?
Tether will buy them. Don't worry.
It's the force of those make a difference in the short term. Typically, foreigners will buy and sell shorter end stuff. Investors stick with the long end. And when it comes to the U.S., just wiping off wealth, if there's deflation, that's all that matters for treasuries. They find yields have to go lower. Government will buy them. I mean, entities buy them. I'm not worried about that so much. It's just the number one force is inflation expectations. And if we get the normal deflation in risk assets, that's the sore thumb. Like I said, we've already had the risk off the rally in gold. It's really expensive. We said, what's left if we continue deflating risk assets? And I like to point out, so that to me, that's the next trade. And we'll see indications. That's why I look at cryptos right now. Bitcoin, if it holds this level and starts breaking down, that's your indications going that way.
But do you guys think that gold is now done, like as in it's topped out for years, or is this just a pullback before new highs? Because if we're talking deflation, then wouldn't that be negative for gold, or would it be negative for gold?
Oh no, it's very positive. There's two things. I'll show one chart. It's the key thing is good for gold are pretty good inflation, the 70s, as I showed in that chart, and significant deflation, i.e. 2007, 8, 9, 10. But here's where I think gold's going. I agree with you. I think its range is now 3,000 to 4,000. This is gold and the S&P 500 on the same scale. I think they're going to revert to 4,000. Gold gets there. But what's the bottom line? I showed this recently. We've showed this too much. This is a bull flag and unemployment. I mean, it's just a matter of time. It goes to 6%. And that to me is what gets it, but it's not going to be easy to ride. So what stops that? I say that too much, Scott. I admit that, but that's what I'm looking for. I'm just looking for the indications in the big picture. Yeah.
I have a question. So you showed that chart or table of obviously the biggest moves in gold. I guess we can't pull it up, but for apples to apples, how many of those years in the top 10, if you didn't look at the entire year, would look like this? Because obviously January to April is not the same as January to December. We could turn around and look at this chart on Christmas and the S&P could be up 10%.
Exactly.
And so like, is it a valid comparison, I guess?
Absolutely. Because the point is, first of all, to point out how expensive it was, how overbought it was at 3,500 an ounce. I mean, it's harder for me to go out and say sell, but that's an indication. Yeah, this is very scary levels. So it depends how you look at it. My point was pointing out gold is right now, if we stay at these levels, it's in the Great Depression, recession, deflationary level. A good point. The point is, I measure it on an annual basis. This is the year so far. And as we go to the rest of the year, do you expect gold to be lower or higher? Now, if it's higher, this is my point. This is where we are. We're running into territory we haven't seen since the 70s in the basis of currency and the Great Depression. If it's lower, everything's fine. Then we're all good. That's my point, though. It got way overbought, and the next key trade is probably if it's just how extreme it is. If this deflation continues, it's probably treasury bonds, gold less so. And what you need is something to reverse, maybe first thing to show indications of this not going this route, which is my base case, and I've been making it for 2 years, is crypto's going up.
So before we get into something else, I want to just show this chart here. This is the inflation adjusted price of gold. And interestingly enough, we basically double topped from the 70s, right? Or from the early 80s right here. So interestingly enough, for those people out there that are like, wow, gold's at an all-time high. Yes, dollar-wise, but actually inflation adjusted, it's basically back to the highs from the 1980s.
I think it's also back to the highs for inflation adjustment. I saw a hilarious chart that was like 1492.
There you go.
Yeah, it was literally like if you priced gold and inflation adjusted, we finally made it back. It was like a Christopher Columbus in disbelief kind of meme.
Incredible.
But yeah,
Very cool. All right, so question for you guys: if right now I'm looking at the Fed Watch tool, and it's showing that they're expected to cut still in June. So obviously not in May. We have a May meeting coming up, but in June. Are you guys thinking that they will do that? Are they going to be forced to? Obviously, Trump putting pressure on them almost probably makes them not want to cut.
I agree, but
because they can't look like they're under his thumb.
We have this interesting perspective, I think, our situation. And I think this is across all parts of the government. We've seen it with the Trump administration where you have half the players saying one thing, half saying the other. It's almost like they're playing good cop, bad cop. Well, Powell has never lied. So you can think whatever you want about whatever moves he's making, but he tells you exactly what he's going to do, exactly what he's looking at, and he sticks to that. So I believe Powell when he says they're not going to cut and he thinks the tariffs are inflationary. That said, just like you get the good cop, bad cop, I think the Fed is now doing that with their presidents and their governors. And a big reason that the market is actually up today is because Christopher Waller said he would support rate cuts in the event that aggressive tariff levels hurt the job market. So saying, okay, of course, our mandate is jobs and inflation. If jobs get hurt, yes, we cut. And then you had the Fed Bank of Cleveland's chairwoman, Beth Hammack, said that the central bank can move on rates as early as June if it has clear evidence of the economy's direction. So I think you have the other presidents jawboning, but saying nothing because they're putting what Powell said in a positive light. They're saying, yeah, we'll cut, but only if jobs are bad. Yeah, we'll cut, but only if the economy's bad. Well, right now, apparently the economy's good, and Powell's saying we're not going to cut. So that was a long-winded way of saying they're supporting the market by saying positive things about something that's currently negative.
Gotcha.
So
yeah, it makes a lot of sense.
What really matters in true cuts is you don't cut 25. You cut 50, 75 when it gets bad.
Because things are bad.
Exactly. And they're not bad yet. I mean, S&P is only down 7% a year. Unemployment's 4.2%. But we all know where it's going. When's the last time you've seen an upward revision in earnings or GDP estimates or even demand for crude oil on a global basis? They're all heading the wrong way.
So going to tariffs now, this popped into my head, so I just want to get it out there. But we've seen 145% that we put on China, and China's put basically almost the same, I think 125% back on us. Is that a shock to the economy? Because I think we can all agree that there's probably no trade going on at this point. I mean, it just literally stopped it in its tracks because no one's going to be paying that much and buying goods. At least I don't think it is going to do. So does that then create a shock to the economy to push it into recession potentially?
Yeah. For the rest of the world, absolutely. And this is one thing Dave Weisberger was really good and pointed out on our program. When the U.S. put these type of tariffs on in 1930s, there weren't anywhere near as what we did now. And we were a net exporter. Now, the thing is, this is a key thing that I remember describing with clients and with trading pits when I was in the trading pits in the 90s. Remember, I'm from the Rust Belt, so we took it pretty seriously that, yeah, everybody in the world wants to have free trade as long as they can run exports, net surpluses with the U.S. Mr. Trump's shutting that off. And it's a major shift for the rest of the world. It's like when you have major dependents and you shut them off, those of us who have adult kids, it's a major shock to the rest of the world. This is unprecedented. And I've heard any economist say that it's nothing even close to this. At the same time, we're having austerity. So I look at it as the key thing that says, yes, this is probably going to be great for our country, particularly for the Rust Belt. But in the meantime, it's taking wealth from the equities, the stock market, and putting back into the heartland. It's a classic trigger. And the point is, it's not like equities are cheap. They're the most expensive in 100 years. Certainly for the rest of the world. So I think it's that shift. It's a global recession. The key thing that I like to point out is these are all indications that we spoke about in this program, and I've been writing about for 2 years from commodities, particularly when you see gold going up and crude oil going down. The world was already heading towards that deflationary area. You saw Germany heading towards recession. China imploding basically just like Japan did in the 30 years ago, and even like the Soviet Union. That was already happening. Now it's got a great catalyst. So I think we're in those early days, and it's a great opportunity for traders. But anytime you see the stock market and risk assets go up, particularly in this country, you're supposed to say that's probably a bear market rally, and that's also the key view from my colleague Gina Martin Adams. This is a bear market.
Interesting.
And just getting started.
So speaking of which, what are you guys, Scott, you think that we're entering a bear market or we are in one at this point, stock market wise? I mean, obviously, I think altcoins have been in one for most of the year already.
Altcoins live in the bear market. Yeah, I would say that we are not currently in a bear market. We're in a bearish trend, only because by definition, I think we tapped a bear market
Right.
That doesn't mean I don't think we're going into one, but I think it's just an early call. Certainly wouldn't surprise me. But you look at some of these things. I think that we have seen what you would describe as a bullish bounce in a bear trend. It looks like a bull trap still until further proven otherwise.
Mike,
so I'm on the edge. I still think this is the time to pull off the Band-Aid, let things fly to the bottom. But I do think that Trump knows that they're gonna have to pull any levers they have to win elections next year. So it can only last so long.
That's the other thing, is how much pain can they tolerate, essentially. But so Mike, you've been talking about equities being at their most expensive in 100 years. Does that mean we are setting up for a 100-year cycle, like a depression type decline in the markets?
Yes.
We're 80%?
Unfortunately. So let's look at this. I'm looking at a normal 50% drawdown. Now we've had, and this is just showing what's happening with S&P 500 versus gold, which just goes back to 1-to-1. 50% drawdown is normal. We've had 2 in the last 25 years, and each one of them, I was lucky enough to be part of it. And boy, the way it was so nice having the pickings when it did go down 50%, and just what you're supposed to be doing. That's why I stick with gold and long bonds. But we didn't have cryptos then. That's why I've been pointing out lately, this crypto market's going to be looked back upon like 1929 in the US, 1989 in Japan, 2000. It's just so much silly speculation. Unfortunately, Bitcoin's at the top of that. So I'm expecting that. I need to see signs of otherwise. And when I say it's a bear market, that's a quote from my colleague, Gina Martin Adams. I've never heard that from her. She has a whole team. They dig into all the inner workings of the market, and she's pointed out earnings expectations are way too high. The misses are getting hammered. It's across the board. It's something that none of us ever seen before. The bottom line is also, those of us who really thought we were going to have a recession 2 years ago, usually what it does, it makes it as hard as possible, and then it finally comes. It's the delayed reaction.
Changed the definition of recession. So there's plenty of people who could argue that we had a recession, or we've been in one, or that we are in one. I just,
here's my definition. When you see friends and family, people pass away. I've seen that before because they were way too loaded
Suicides.
up.
Yeah.
Well, not sure that, even consumption. I mean, lose their homes. I've seen it partly in the big bubble in early 7, 8, and 6, 7, and 8. I remember having a friend who was just way too long speculative internet stocks, and that's why I see cryptos right now. I'm like, that's my point. Is this is going to be something we haven't seen? It probably as bad as 2008. I hope something stops it, but it's just the point is it's very much like 1929. Everything started when the stock market just went down. Because why? It went up too much.
One quick question on that too, and this is going back to tariffs, but also the implication for a really bad recession or pseudo depression. But one of the things I keep on hearing is that in the 30s we had tariffs, and it really kept us in the Great Depression until World War II. But I know, Mike, you're kind of you generally have a positive view on the need for tariffs, and I just was curious about both of yours. In fact, your thoughts on tariffs, and does it then does it cause issues like we saw in the 30s, or was there something else at work there?
Well, I'll just, the key thing that really struck me was from the book, No Trade is Free by Robert Lighthizer, and things that I've sensed my whole life and seen the Rust Belt turn into the Rust Belt is, it is impossible for anybody in any single country in the world, particularly Canada, which is 1/10 the size of the US, to have fair trade with the US when their neighbor is 10 times their size and much more dependable. To make the access to our country similar to our access to theirs and what we can sell to them, you have to have a minimal 10% tariff. You have to. It's just no way offset that. There's no such thing as free trade when you have this situation and no currency adjustment. And it's just true. There are many things true that many countries have taken advantage of the US forever. Now we are shifting that back to maybe less. We had 0 tariffs forever, and most of the rest of the world had major significant tariffs against us. It's the same thing Alexander Hamilton pointed out 250 years ago, how to really gain the upper hand. It's just good mercantilism. But now we're shutting that off. The rest of it's not free trade. It was the rest of the world being completely dependent on exporting to the US. That's a complete shift in the world order since World War II. And maybe us even providing their protection. I mean, as much as you love them or hate them, our president, our government, this is what's happening. And what's going to take to really stop it? I think one thing to slow it down is what we've seen is the stock market going down.
What about you, Scott? Any thoughts on it?
I mean, I know we've only got a minute left. Listen, I think that tariffs can be a great policy if you go case by case and address each nation. And if there's actually an unfair advantage to one side, you negotiate reasonably with them. I don't think we can compare this to the 1930s or any other times in history when we had tariffs, because we were, shipping things across the ocean on steamliners like the Titanic or worse back then. And, now you just fly it out on a private jet to avoid the tariffs. It's just not the same world. Everything's global. Everything is intertwined. And I just don't think there's a comparison. There is literally no way right now that we can cut off trade with every country in the world. Or
So that's the key thing.
I think go through these tariffs.
We're not cutting off. We're just trying to rebalance it where the whole world is just not exporting their surpluses to UX. And that's the key thing that's happening. China has a massive...
We're exporting them our inflation and our global reserve currency, and they probably don't want to deal with that.
Right.
Either,
and just to, before we end, I know we got to get going, but my biggest fear is that by alienating pretty much every country out there, and listen, you could argue tariffs are good or bad. I agree on a case-by-case basis, but probably not blanket tariffs are great. But the question is do these other countries start to say, wow, we can't rely on the U.S. as a partner as much anymore, and then shift away from the
Europe and China are already discussing a lift of sanctions. There's no question it's going to be us or them if it continues this way. And you can actually look at a map of if the United States or China is a larger trading partner of any country in the world, and I promise you that map is more red than blue.
So one thing that the difference is, it's not a partnership. It's more of a host-dependent relationship. Just trying to rebalance that. Now he's attacking it really hard with a sledgehammer, but it has become much less of a partnership. And the key thing is, you're right. In the 30s, global trade was a much smaller portion, but trade in this country is like 10% of GDP. In Germany, it's 50% of their GDP, and it's all exports. And they all export.
Just saying, in the 30s, we got out of the Depression because we had a war, and the United States made everything, and that's what stimulated us out of a Great Depression. We don't make anything, so maybe that's
the thing. We haven't because partly we gave the rest of the world a free hand and access to a market. That's shifting. The point is, we can argue about that forever. The bad news is, what does it mean for markets? This is happening with the U.S. stock market, the most expensive in about a century. Crazy. What does that mean? Reverse.
All right. I think that's where we ended, boys. So another great Market Mavericks. Thank you, gentlemen, for joining as always. Socials below. Please go follow everyone here, folks, as, again, the great content on the socials that are being posted. Thank you all. We'll see you next Thursday. Take care.